but it's a psychology. I remember it very clearly in 2008. Once the stock market going down, and I lived in Fairfield, Connecticut, a wealthy area, and the spending just shut off instantly. And once people don't see their statement, see it's giving back 20%, it's not going up right away. Even their house that doubled in the last 10 years is trickling down, and it shuts on everything. And we're just overdue for a normal cycle. Maybe it's starting soon. I think it's going to be starting this year. Maybe Trump will save us, but the market's priced for so much optimism. I'm just pointing out the potential for a little bit of normalization. And maybe that starts today. I don't know. Today's just a normal little backup. But I think Bitcoin was the best leading indicator after the great financial crisis. I think it's perfect to show us where we're going to be heading in the next few years.
And Bitcoin, let's be fair, Bitcoin was a great indicator of the top in 2021 in the stock market. I think it topped about 6 weeks prior to the stock market.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
So it's just something to keep an eye on there.
A simple measure of Bitcoin versus a 100-week moving average breaking down. You see the S&P 500 versus a 100-week moving average. It's just really expensive. Most rational traders don't buy there. They just look for spots you ride it for a little while. You look for put strategies. Also a key thing I want to show you about Bitcoin. Again, this is the key thing I've been pointing out for a while. It's that divergent weakness. Bitcoin versus gold. It's been breaking down when it should be breaking out higher, and this is overlaid with the S&P 500 E-minis. 2 gaps below the market. Since 1997 on a weekly chart, we've never left one gap. Key thing that really struck me in 2007, I focus on this a lot, and this is just look at volatility. S&P, the VIX volatility index versus T-bills, a 52-week moving average. It's very low, potentially bottomed again. Bitcoin versus S&P 500 is breaking down, and on a pure technical basis, it's about 10 right now. There's no reason it can't get back to 10 and 7. It doesn't mean anything in the big picture.
Technical analysis offers valuable insights for understanding market trends and making informed trading decisions. One key aspect involves comparing the moving averages of different assets, such as Bitcoin and the S&P 500, to develop effective trading strategies. Moving averages smooth out price data to identify the direction of the trend. They are particularly useful for traders to determine entry and exit points. When comparing Bitcoin and the S&P 500, we observe that both markets can exhibit distinct behaviors despite being influenced by broader economic factors. For instance, Bitcoin, as a cryptocurrency, often shows higher volatility compared to traditional assets like the S&P 500, which comprises a basket of large-cap US stocks. By analyzing the moving averages of Bitcoin, such as the 50-day and 200-day moving averages, traders can identify bullish or bearish trends. A common strategy involves looking for the golden cross, where the short-term moving average crosses above the long-term moving average, indicating a potential uptrend. Conversely, the death cross, where the short-term moving average crosses below the long-term moving average, suggests a downtrend. These patterns can also be applied to the S&P 500, providing traders with signals on potential market movements. Observing divergent weaknesses between Bitcoin, gold, and the S&P 500 reveals further nuances in technical analysis. Divergence occurs when the price of an asset moves in the opposite direction of an indicator or another asset, signaling potential trend reversals. For example, if Bitcoin shows strength by maintaining its price above a key moving average, while gold and the S&P 500 demonstrate weakness by falling below their respective moving averages, it may indicate a unique underlying strength in the cryptocurrency market. This divergence can alert traders to shifting market dynamics and potential opportunities or risks. Similarly, when gold, a traditional safe haven asset, diverges from the S&P 500, it can reflect investor sentiment towards risk and safety. If gold is rising while the S&P 500 is declining, it suggests that investors are seeking refuge in gold amidst market uncertainty. Conversely, if both assets are declining, it may indicate broader economic concerns affecting all markets. By closely monitoring these divergences and the behavior of moving averages across different assets, traders can gain deeper insights into market trends and enhance their trading strategies. Understanding these technical patterns and their implications allows traders to make more informed decisions, adapt to market changes, and potentially improve their trading performance.
I want to tilt over to something I think that's really significant I published today. Economic Surprise Index in the country is tilting over the way I think it really should. It went too far the other way. Now we're seeing all the signs of that overdue recession just starting to kick in. It's at the lowest in about 10 years. Now I overlay this with gold versus the S&P 500. Gold is just so cheap versus that S&P 500. Just a little pop up should do that, and it should happen. I think it's just a matter of time. That's what I'm showing here. But I want to show you a few others, and I'll lay low and see your response.
Economic indicators play a crucial role in understanding the overall health and direction of an economy. One such indicator, the Economic Surprise Index, has recently signaled a potential recession. This index measures the difference between actual economic data and the expectations of market analysts. When the index shows that economic data consistently falls short of expectations, it can be a red flag for economic downturns. A persistent negative trend in the Economic Surprise Index suggests that the economy is underperforming, which may lead to reduced consumer and business confidence, decreased spending, and ultimately a recession. This indicator's current signals have therefore raised concerns among economists and investors, prompting closer scrutiny of other economic measures to confirm or refute these recessionary warnings. One critical measure closely watched is the U.S. Consumer Price Index, CPI, which tracks changes in the price level of a market basket of consumer goods and services purchased by households. The CPI is a key indicator of inflation and cost of living. Its fluctuations can have a significant impact on various asset classes, including cryptocurrencies like Bitcoin. Historically, Bitcoin's price movement has shown sensitivity to inflation data. When the CPI indicates rising inflation, Bitcoin is often seen as a hedge against the devaluation of fiat currencies. Investors may flock to Bitcoin, driving up its price. Conversely, if the CPI shows lower inflation or deflation, Bitcoin's appeal as an inflation hedge diminishes, potentially leading to price declines. Understanding the interplay between economic indicators and asset prices is essential for making informed investment decisions. The recent signals from the Economic Surprise Index and the movements in the U.S. Consumer Price Index are crucial pieces of this puzzle, highlighting the interconnected nature of economic health and market dynamics. As these indicators continue to evolve, they will remain central to predicting economic trends and guiding investment strategies.
This decoupling is especially worrisome given that spot Bitcoin exchange-traded funds, ETF, captured $800 million in inflows over the past 4 trading days, as per Farsight Investors data. To make things worse, the U.S. dollar index, which measures the U.S. dollar against a basket of foreign currencies, declined to its lowest level in 5 weeks at 104.4. This suggests investors are not seeking shelter in cash positions, which could partially explain Bitcoin's bearishness.
So Ethereum, I've been watching CNBC in the morning, getting ready for work, and basically I'm seeing these Bitwise commercials for the ETF nonstop for Ethereum. And do you have any information on that? And do you think like we could see a run up because of that, or is it more of a wild card?
I think we saw the run up when they were surprisingly approved. We added, 30%, I think, to Bitcoin to Ethereum in a matter of 2 days. I had Eric Balchunas and James Seyfert on my show yesterday, the 2 ETF analysts from Bloomberg, specifically talk Ethereum ETF. They think July 18th, their best guess for them to start trading. So that's a week from today. But they also thought that there was a likely chance they would have launched a week ago. So they say take it with a grain of salt. We don't really know what the SEC is doing here, but they are coming. Listen, it's going to largely depend on what Grayscale does with their fees on the Ethereum trust, right? We saw that there were a number of reasons why people were selling GBTC after the approval, right? You had the people that were playing the discount trade. You had the people that had been locked and just wanted to get out. And you had people who were seeking a lower fee than 1.5%. If Grayscale comes in at 1.5% again and everybody else is at 19 bips, we're going to see a massive sell-off of the 8 to 9 billion in AUM of Ethereum. And we're going to get that sell the news. But once again, it's a fundamental, like you can watch those coins being sold. That's the transparency of this market. But if they come in with a competitive rate, and I think they're going to launch those Ethereum minis, maybe we don't get the massive sell-off from selling pressure. But listen, 8, 9, 10 billion, depending on the price in ETH, that's a lot of Ethereum relative to the market size, even more so than the 25 billion that was in GBTC was to the total size of Bitcoin.